Good morning. Today is Tuesday, January 24th. We would be here. I know we're a little bit, maybe a minute and a half late, so apologies for that. Some technical difficulties getting on this morning, but we're going to jump right into it because we have a lot to get to. I have 6 pages of notes this morning, so
I have no notes.
It's going to be a doozy, but we have some really good stuff. So first of all, just kind of some housekeeping things. You may have seen DOJ is poised to sue Google over its digital ad market dominance is about 80% of the business. Bear in mind, the DOJ has also filed suit against Google for search, market share, et cetera. So this is not new. They have also defended themselves 3 times from state attorneys general. So, this is just kind of par for the course. When you have 70% of the market, you're going to get sued. I think at some point, we may see some issues as a result of this in terms of we've seen the big fines in the past, which have really just become a pseudo tax for them. And when they pay 14%, 12% tax rates, okay, pay another 0.3%. You build it into the models, but it'll be interesting to see if that heats up over the course of the next decade. I wouldn't expect a huge market moving piece of news as a result of this. Tom?
Yeah, I would agree. I mean, the only thing that gives me pause is that the verbiage they're using is essentially the same kind of structure they went after Microsoft for. Microsoft, it was the Internet Explorer or Netscape Navigator, whatever the early one was, where they said, they're trying to dominate access to the internet by loading up every single PC with the same software. And they're basically saying that with Google, that they're loading up their phones, they're advertising apps in the Google store, all funnel through Google. And that's sort of the tack they're taking, but I don't expect it to be a big splash. To your point, it's not the same as the early Wild West of PC computing with Microsoft, but they're kind of taking the same path to trying to nab them on something.
Yep. On the regulation side, that we keep hearing these headlines about pensions. I think this is just spin zone. We have a lot of spin zone this morning, so I think just really understanding what's going on is important. So Bank of America and JP Morgan are facing shareholder resolutions from New York City's top pension official. They want to invest only in ESG companies. Meanwhile, you have Florida saying you cannot invest in ESG companies. So this is just politicians being politicians, and I ultimately don't think that it should really impact stocks that much. But if I'm a pensioner and I'm reliant on this, I'm just like, guys, spend your time making good investments. Don't do private equity. Don't do illiquid investments. Don't do these hedge funds. Don't do the fund that your buddy did. I care a lot more about that than doing the ESG. I mean, as a pensioner, I want the best return that I can get.
I mean, think about last year, what was the number one performing stock in the S&P 500? I believe it was ExxonMobil, at least in terms of the mega caps. So the question is, if you're in New York City and they outlaw investment in ExxonMobil and you can invest in almost anything else, you're probably down 30%, 25%. I mean, Exxon was like the leader last year. And so I think it's one thing to have feel good. It's another thing to be able to retire effectively. And for these pensions to work, I mean, there are a lot of people affected, particularly in New York City.
Already, these pensions are in really bad situation because they just took a big haircut on their bonds. I mean, I don't know.
It's just like, let's not get cute. You know what I mean? Like,
do your job.
Yeah, just do your job. Make sure that people can retire. Let's not make a political stance out of it.
Amazon is looking to unveil a $5 subscription plan for US Prime members covering generic drug delivery. So this would be on top, I presume, of your Prime membership. And I think we're beginning to see this with Amazon. You're starting to see them add costs to that Prime membership. You can get Super Prime. You can get, if you want video, if you want music. Now, if you want generic drugs, you can get a $5 subscription plan from Amazon. It's called RX Pass. It includes 50 medications, including high blood pressure, anxiety, diabetes, and baldness. I think it'll probably pick up fairly well. I think this is what the consumer generally wants. I think you could probably get it from a lot of places other than Amazon, but Amazon is leveraging its position in the consumer's wallet. What's interesting here is that if you're enrolled in Medicare, Medicaid, or other government-sponsored healthcare, you won't be able to enroll.
Interesting. Yeah, I mean, who likes
Which
going
is
to
going to
the,
be a lot of these people.
who likes going to the pharmacy? Does anyone go in there and think, man, that was an unbelievable experience? Or CVS's and Walgreens slowly turning into gas stations and not good ones?
Yeah. So it'll be interesting where they source them, who the pharmacy benefit manager is on that, because they'll probably need that. The OPEC plus meeting is going to be on February 1st, which is actually the same as the Fed day. So that's going to be a big day for policy announcements. Right now, there is no change expected in terms of oil production from OPEC. But we're going to continue to watch that as they watch the reopening of China and the impact of Russian sanctions. Labor market, there was a story in the Wall Street Journal about temp workers increasingly being laid off. There were 35,000 jobs cut in December alone. But again, this also is reflected in the weekly jobless claims data, which is continuing to decline. So these people are either getting hired pretty quickly after they come off their temp job, but we are starting to see a little bit of a pullback in temp workers. But again, it's not being reflected in the weekly jobless claims yet. So for now, I think this is something to keep an eye on, but not something to panic about. All right, let's talk about earnings. 3M, you guys probably know it because it's the maker of the sticky note. They also make those things that don't work, that hang up pictures in colleges. A lot of times people use them because they don't want to put holes into the wall. Man, this company is unbelievably badly managed. It's this Mike Roman guy, the CEO of it. He continues to make excuses. This time he said consumer electronics are going to be down sequentially, including smartphones down 10%, tablets down 15%, TVs down 30%. I mean, you hear that and you say, okay, well, maybe I'll give 3M a pass. Don't give 3M a pass. Electronics are always down in Q1. This is not a surprise. What did you think was going to happen? And they just guided to earnings per share for Q1 of $1.25 to $1.65. The estimate was $2.50. They can't manage their margin. They can't manage their revenue. And they can't manage their customer. They're blaming headwinds from disposable respirator declines as a result of the decline in COVID. Their guidance for the full year for 2023 is between $8.50 and $9. They made over $10 in 2018. This is a company. So if you're blaming the respirators, okay, maybe you go back to 2018 levels plus inflation, plus some margin, plus some growth. No, they're 15% below 2018 levels. I mean, it's absolutely embarrassing. They whiffed on revenue and EPS for the quarter itself, even though they reduced guidance multiple times throughout the year. I'm telling you, some places in corporate America, these guys need to get fired, but he's firing 2,500 of his manufacturers, 2.5% of his workforce. I think the wrong people are getting fired here.
I mean, I think 3M is essentially suffering from GE syndrome. We saw the massive decline of GE during the 2010s based on the fact that they had just gotten into too many different business lines. And 3M, I mean, it stands for Minnesota Manufacturing and Mining. They're best known for sticky notes. They make a ton of stuff. I mean, it's in all kinds of weird business. Yeah, Kevlar. They make electronics. They make they have mining materials. They have semiconductors. I mean, you name it, they make it. But the problem is they're not really good at anything, and it's starting to show. And I think that the move, is to start seeing just spin-offs of businesses. And we saw it with GE spinning off like Synchrony Financial, as a whole separate company now that has nothing to do with General Electrics at all. But now it's a fully standalone bank, or GE Healthcare. 3M needs to just split up. They need to figure out which business lines they want to attack, and they need to focus on those. And they just need to sell off everything else because they're just crumbling internally, and it feels a lot like GE.
And I think the CEO kind of gets away with it. The GE, there's really no place to hide. It's General Electric is one of the biggest companies in the world. It's one of the most celebrated American companies that was really in dramatic decline. 3M kind of floats under the radar. But again, I think the wrong people are getting fired today. I think the CEO needs to be fired, and I think it can't happen soon enough. It should have happened last year. Verizon, talk about spin zone. These guys snuck in. I was looking through the results and I was thinking to myself, man, the revenue looks good. EBITDA looks okay in terms of the estimate. EPS is not good, but I wonder if there's something with the tax rate. Well, the tax rate's about in line. The reason the revenue is good though is, and they snuck this in the presentation in a footnote. They guided to 2.5 to 4.5% wireless service revenue growth, which, not terrible. It does include some of their TracFone acquisition, which happened in the middle of last year. So that's just a little bit, but the estimate was 1%. So I was thinking things are looking up. It includes almost a 2% tailwind from a change in accounting, basically bringing other revenue into the wireless service revenue piece. So you strip that out and you're up 0.5% to 2.5%. I mean, de minimis revenue growth for this company. They continue to spend a lot of money on capital spending. I would say that their margins have improved a little bit, and their net subscriber additions were a little bit better than I expected. So the quarter was actually reasonably good, but the sneaky guidance really left a poor taste in my mouth. The stock's down about 2% today. Unfortunately, this is just Hans Vestberg, the CEO. I love the guy's energy, and he's extraordinarily creative when it comes to accounting. But when it comes to the actual business, I think that he's relatively unimaginative. He comes from Ericsson, which is just a wireless equipment provider, kind of a commodity product. And he is not managing Verizon with any degree of creativity, vision. And I'm disappointed at him. I'm disappointed at Verizon. Tom?
I mean, I'm looking right now. I just wanted to get an idea because they have $134 billion in debt. And the average coupon on that debt is 3.19%. And that's not a good position to be in if you're unable to grow revenue and you've got maturities coming down the pike. So they have 297 bonds outstanding. So there's not a ton of maturities in 2023, but 2024, 25, 26, you start to see a tick up. They've got to refinance this debt. They're in, I would argue, an eroding position from a financial standpoint, and they're going to have to take on coupons that are higher than 3% because your treasuries are at 4%. And so that's a pretty dire situation. They've got to get this thing turned around because they're going to be in a debt problem sooner rather than later, particularly if the Fed commits to staying at higher rates. So that's what I'm keeping an eye on Verizon. We've probably sold, I would guess upwards of 75 to 80% of our Verizon holdings in the last year, just because they've not performed very well. But it's a company I'm not excited to jump back into anytime soon.
I have a few more for you. Johnson & Johnson reported earnings. There's another company where I'm just disappointed with how they did. The quarter came in okay. The guidance was better than expected, but as far as I'm concerned, what's happening underneath it, the company is not good. They're increasingly reliant on Darzalex, which is their big oncology platform. They're going to be losing Stelara, which is their treatment for Crohn's disease. That's going to be coming off patent in the second half of the year. That'll probably have a little bit of residual revenue, but it'll probably be in decline at the same time. Medical devices, the growth rates look good, but that's just because they're comping over very, very easy periods. And you're just not going to sustain 6% growth in hips and 7.5% growth in knees. That's not what the growth profile is of these businesses. You're at low single digits at best, probably low single digit decline more likely in those types of medical devices. And on the consumer side, yes, they did very well in over-the-counter drugs, but the rest of the business, beauty and baby, really underperformed. Baby especially down 5%. I was quite disappointed with. Most of that was international. And I'm just wondering if they haven't continued reverberations from that talc issue. So they're planning to spin off the consumer business later this year called Kenvue. That'll be in the second half of the year. And I think that people are looking for that to be a catalyst. Right now, I'm a little bit concerned with what businesses remain in terms of the pharma business and the medical device business. There's not as much growth and dynamism in there as I would like. So we'll see what happens with Johnson & Johnson. The stock's up. It was up 2% when I was looking at it, but I'm a little bit disappointed with how they've been performing. Hitting you with some other ones. DR Horton came in with earnings. I was surprised by their cancellation rate actually falling from last quarter. The cancellation rate was 27%. down from 32% in Q3. Net orders was still very bad. Their backlog is down pretty much half compared to this point a year ago. So definitely taking it on the chin in terms of the housing market, but D.R. Horton does play in some of those lower cost housing, which is what we need more of. And so I think that when this thing begins to turn, and we're beginning to see signs of the housing market turn, in part because of mortgage rates, I think that D.R. Horton's going to be a prime beneficiary of that.
Yeah, I think we're starting to see the house. What we're seeing now in the terms of this data is Q4, right? And Q4 was probably the biggest slowdown in housing we've seen, hikes to date. So now that we're seeing mortgage rates fall, I think this is probably just a little bit antiquated, but still not a great sign that their backlog is eroded so aggressively.
Yeah, I think the conference call, so we just have the press release to go off of, but the conference call, which will happen later today, is going to be very informative in terms of how things have changed and maybe shifted in the last 3 or 4 weeks. Elsewhere in the industrial space, we did get results from Union Pacific. I thought their guidance was good, but their revenues were very poor in the past quarter, but I think guidance for next year is good. So I would expect those declines that we're seeing in the pre-market to reverse and Union Pacific to potentially go up later today. Halliburton, the oil field servicer, just continues to go from strength to strength, driven by international demand, especially in the Middle East and Asia, as oil production tries to come online a little bit more aggressively. In the defense space, Lockheed Martin and Raytheon both reported earnings. Lockheed, I mean, when you compare it to Verizon and Johnson & Johnson and 3M, Lockheed isn't playing nearly as many games as them, which is a little bit of a change for Lockheed. And so I give them some credit there, but I think they're in a tough place right now. And there's just that money on the defense side, especially on the aviation, the F-35 side isn't coming in as fast as maybe it would be, they would like. They are trying to improve what they can control by aggressive share repurchases, but their free cash flow isn't coming in as strongly as it has been in years past. Raytheon, on the other hand, is very much helped by the continued recovery in commercial air traffic. They're actually doing their investor day at the Paris Air Show on June 19th. And then finally, a couple pieces of good news. General Electric, their profitability is really coming in well. Larry Culp has really worked hard at improving this business, and they're improving the profitability here. And we're going to continue to look at this. We are looking, and you may have seen us reference a healthcare company in the market memo. We are looking very strongly at GE Healthcare, which is the spun off entity, but GE is actually, for the first time in a long time, beginning to demonstrate better profitability, better free cash flow, and that's something that we need to keep an eye on. And then finally, PACCAR, the the provider of trucks, Kenworth, Peterbilt, they're seeing continued strong demand, saying that the increased fleet age is really driving demand for parts and new trucks. So it's a mixed bag in terms of the earnings outlook today. I would say there are some that really disappointed me, but I think a lot of that's kind of a management issue. And there are some that are outperforming, and also because of management. I think Raytheon's doing well, PACCAR's doing well, GE's doing well. 3M not so much, Verizon not so much, Johnson & Johnson not so much. So I think this is a market where if you're betting on the jockey, not the horse. And I think that's what we're going to continue to emphasize here at Narwhal.
Yeah, I would tend to agree. They're saying that we're kind of heading into a stock pickers market, but you really need to be understanding of management, understanding of what they're actually trying to do. And the companies that don't have a direction, I mean, 3M is just a great example. They don't know what they're doing. They don't have a defined business plan. They've got 15 sort of hazy business plans. And I think that's a recipe for disaster in this kind of market. And Verizon's kind of the same way. So that's where that divergence is. And so I think it makes it more critical looking at these companies, reassessing even the ones we already own and trying to figure out which ones are operating and which ones are not. Yep.
And if you're interested in anything more on any of these companies, we're doing all this work. We just tried to hit the high points today, but if you're interested in just a little bit more color, what we're seeing, how we're approaching these problems, please let us know, and we're happy to share some of our research and our thoughts. With that, we're going to end this lengthy call, and we'll see you tomorrow.